If you took all the stock markets in the entire world, they're, let's say, in the $60 trillion levels. But if I took all the real estate markets in the world, including housing, it's 230 trillion US, 4 times as big. And if I take housing out of it, the commercial real estate markets are at least $100 trillion. So if more of the world's wealth is in real estate than in stock markets, it would be reasonable to argue, shouldn't more of a client's portfolio be in?
When I'm looking at acquiring a property, because we're also investors in it alongside of our clients, I'm looking at this acquisition as if it's for myself.
The price of real estate investment trusts can be significantly swayed or moved based on human emotion. So our thinking was, if we wanted to invest in real estate for our clients, the most value-driven way was to go out and buy the actual real estate.
Really what we want to do is build a portfolio that you might hold on to for 10, 20, 30, maybe 40 years with no particular selling frame in mind. So the idea is you needed an open-ended pool where you can choose when you're in and when you're out. I would say those would be the fundamental differences.
I'd really truly believe that clients feel a sense of pride of ownership with properties.
Our clients entrust us with their family's legacy, and it makes me extremely proud that we've built the team that is able to deliver on that need that our clients have.
For those of you I have not had the privilege of meeting yet, my name's Cameron Smith. I am Vice President of Advisory Services at Nicola Wealth, which essentially means I have the privilege of working directly with our advisory team, based both here in BC and in Ontario. Before we begin our evening, I think it's important for us to acknowledge where we are, obviously some natural beauty, and to speak to the fact that real estate and land are undeniably linked. As such, we would like to acknowledge that tonight's event is taking place on the traditional and unceded territories of the Squamish, Musqueam, and Tsleil-Waututh First Nations. It gives me great pleasure to welcome you all here tonight. This is our first client-centric in-person event since March of 2020, and we did have an event right before COVID changed the world, and it's been a long stretch between now and then. I know our real estate team our marketing team rather, thrives in an environment like this. And they have literally been counting down the months and the weeks and the days and the minutes up to this moment. So it's great to be here. Some of you may be asking why I might be on stage as opposed to our president, David Sung, who was featured in that video. David was included in the invitation as our host for this evening, but unfortunately he is not able to present this evening. His mother, Nikki, lost a really brave battle with cancer over the weekend. And Nikki had a really wide group of very caring friends in this city and in other places in the country. And just wanted to acknowledge to David, Danielle, the entire Sung family that we're thinking of you during this time. Thank you. So as many of you would be aware, we saw it featured on the video. At Nicola Wealth, we pride ourselves on offering sophisticated and unique investment opportunities, and real estate is a core component of that offering. We're very excited to bring together an extremely impressive group of speakers for you tonight. This evening, we welcome the MLA for Vancouver Quilchena and leader of the official opposition, Kevin Falcon. Kevin will have a fireside chat with our Managing Director of Real Estate, Mark Hanna. They'll discuss market housing, social housing, and how the private sector can actually support the public sector. Following this conversation, we'll welcome an expert panel of real estate leaders. In this moderated discussion, they'll weigh in on the impact of current and future trends, as well as major disruptors in the real estate environment. But before we get to our guest speakers, we wanted to provide a brief macroeconomic update. There are a few moving parts in the world right now that we thought we would speak to. So earlier this year, our fearless leader and CEO, Jon Nicola, published a newsletter, and he used Charles Dickens' classic novel, A Tale of Two Cities, as the theme. And the opening words in the novel, I would argue, are very appropriate for where we are at today. So it was the best of times, it was the worst of times. It was the age of wisdom. It was the age of foolishness. It was the epoch of belief. It was the epoch of incredulity. It was the season of light. It was the season of darkness. It was the spring of hope. And it was the winter of despair. Now, I know all of that sounds very dramatic, but there are some parallels to where we are today. And I would argue that we have experienced two very different realities, even this year alone. If we were to go back in time, one might think that we had been living in the best of times at the beginning of this year. So back in January, both public markets and residential real estate were absolutely booming, hitting record highs. Scientists from across the world came together in an unprecedented way to quickly deliver COVID vaccines. Environmental, social, and governance issues are driving investment decisions, which is fueling new industries such as sustainable energy. Recent data was pointing to progress in developing nations with regards to literacy and poverty issues. And any talk of interest rate hikes was really followed by words of slow and measured. And there was no thinking that there would have to be a drastic approach to interest rates. Fast forward to now, I wouldn't necessarily call it the worst of times, but there's certainly an element of pessimism that's crept in. So we've had huge increases in both corporate and government debt. There's more than enough tension right now between China and the United States, particularly over Taiwan. There's obviously a very tragic humanitarian situation in Ukraine. And that conflict is putting pricing pressure on very key global commodities. There's an interesting and I would say further volatile political situation in many places in the world. The United States would be an example of that. Several equity markets across the globe have officially crossed into bear market territory, down by more than 20%. Supply chains are still disrupted. I am currently trying to buy a car, and even if I walk into a car dealership with a fistful of cash, all I can walk away with is a sign up for a waiting list. The Fed and Bank of Canada are aggressively raising interest rates. For those of you who pay attention to the news, there was a 75 point increase yesterday in the US. More increases are likely. And those increases are being coordinated in an effort to halt the drastic inflation that we have seen in recent months. Aggressive interest rate increases can certainly lead to recessions. So I'm very happy to call on one of my colleagues now to come up and continue this discussion. Ethan Astaneh has more than 15 years of experience in the wealth management industry. He's a wealth advisor and client relationship manager with us at Nicola. He's a director for the Financial Planning Association of Canada. Some people were commenting earlier today, he is a host of the Nicola Wealth podcast series, and he's a key leader within our firm, helping to train and mentor our next generation of advisors. So very happy to call on Ethan to come to the stage.
Ladies and gentlemen, thank you for joining us this evening and making the time. As Cam mentioned, I'm going to give you a bit of a global update. Now, don't worry. This won't take that long. If I'm picking up what he was putting down, there's not much going on in the world right now. Okay, so we're going to jump into market and economics really quickly. So global stock market indices are down. The S&P 500, the Hang Seng, the Euro stocks, 20% roughly. The NASDAQ is down about 31.5%, and the TSX about 10%. The reason for that outperformance is because of energy stocks. These figures as of yesterday's business close, a little bit worse today. Now this is a price path chart of the S&P 500. And near the relative recent bottom that occurred in June, we had produced a market commentary called Are We Bear Yet? In which we described that the bear market is a period of prolonged market decline in which you can typically be for 18 months. So it's important to keep in mind that we're actually only 8 months so far through this one. And then immediately after we produced that, stock markets went on a bit of a run. And we saw this 10% increase, and prognosticators were saying the market has bottomed. It is now behind us, and the era of growth is nigh. But that actually turned out to be what we call a dead cat bounce, okay? And this isn't uncommon in a bear market, okay? You'll see these temporary, short-lived 10% increases in between pretty significant decreases. And usually, when the stock market is doing this, we're going to be looking to the bond market for safety. But if your financial advisor was Dwayne Dog the Bounty Hunter Chapman, what he would say to you is you can run from risk, but you cannot hide. And the reason he would say that is because bonds, a proxy for how bonds are performing this year, are down 11.36% on a year-to-date basis. Now, this doesn't happen often. In the last 100 years, there were 2 years in which both stocks and bonds declined, 1931 and 1969. Now, this pressure on bonds is coming because of increasing interest rates. And just yesterday, the Fed announced that the funds rate is now 3.15%, and it sounds like they're going to march it forward to 4% by sometime next year. We would have to go back about 15 years to the global financial crisis to find a time when interest rates, when the Fed funds rate was 4%. Now, it being at this level isn't exactly the problem. The problem is how quickly we've had to go from near zero to that level. These successive jumbo hikes in a very short period of time. And they have to do it because we're dealing with the three-headed beast of inflation in wages, in goods and services, and in the cost of parking in downtown Vancouver. Now, we like to look at the nuances of interest rates. What you're seeing in the white line that's shaded in blue is the yield you would get on a 10-year treasury at any given point in time. And it stands to reason that you should get a higher return if you're making a 10-year commitment on your capital than if you invest for 2 years in the treasuries, which is what the red line shows. And most of the time, you see the white line is above the red line. Those are normal market conditions. But every now and again, what happens is they invert. And that 2-year rate is actually higher than the 10-year rate. So you're probably wondering, okay, are we reading tea leaves and does this matter? The reason we feel that this matters is because if we go back over the last 50 years and we adapt the chart, and every time the yield curve inverts, you see it hits that bottom line, every single time that this has happened in the last 50 years, it has been followed by those gray columns you're seeing. And what are those? Those are recessions. So to be clear, with 100% accuracy, in the last 50 years, an inverted yield curve has predicted an ensuing economic recession. Now, let's pivot and talk about geopolitics. So we've got a dual threat here, and first we're going to talk about Russia. So the war in Ukraine is obviously center stage, and the balance to strike is ensuring that the sanctions are strong enough to prevent Russia from advancing its agenda in that regard, but not so strong that it grinds the gears of global economic trade, specifically energy as well, to a halt. What's also interesting is whether or not they actually have any military strength beyond just equipment, because it seems to us that they're pretty low right now in both morale as well as soldiers. Now, Russia also actually has kind of a weak economy, and I say that because the population of Russia is 4 times the size of Canada, yet our economy is bigger. And they've got a declining population, which is being exacerbated by some of their best and brightest minds fleeing the country, specifically in information technology. Now, China has been dealing with some economic drag as a result of the zero COVID policy and the lockdowns. And on top of that, we now have stacked a pretty significant property market decline. This is notable. 30% of China's GDP is related to the property market. And so when that falls, that impacts their economic output, and they're the world's second largest economy. So, and to make matters actually more interesting, the price declines would be even worse if they weren't setting prices. If you let them free float, the issue actually becomes worse. And then of course there's Taiwan. And exactly what happens there, we might learn the playbook depending on what happens with Russia and Ukraine. Now, there's also command and control over tech companies. Companies like Alibaba, Tencent, Didi. They're down 40 to 75% from a year ago, okay? And then they're also dealing with a declining population for number of different reasons, but the big one, of course, one-child policy. Okay? Now, in his book, author Peter Zeihan, called The End of the World is Just the Beginning, he argues that we are also dealing with a period of deglobalization, meaning that past decades we've been benefiting from the effects of globalization, and now we're going to see that reverse a little bit. And his argument is based on a few factors. One, the length and complexity and costs of supply chains. Cam's vehicle, for example. Two is US isolationism, and this has been afforded because around 2015, in the aftermath of the shale revolution, the US became energy independent. There's also depopulation of the world, which is going to be mentioned more than a couple times in this presentation, and also the reshoring of manufacturing from Asia to the United States and Mexico, which interestingly we have a trilateral trade agreement with, a relatively new one. Now, Zeihan argues that energy and food independence are key because global tensions are rising, and some good news, he declares North America to be the winner. Now, sounds positive, but I'm going to give you a word of caution. If you read a word of Zeihan, what you're going to discover very quickly, he is an alarmist, he uses hyperbole, he thinks every catastrophe is going to happen tomorrow, but they take decades to pan out. Let's take a quick look at demographics. Now, in his well-constructed book, The Next Age of Uncertainty, Stephen Pelosi explains that there are 5 tectonic shifts that governments are going to have to deal with from a policy perspective over the next 10 to 20 years. The first, aging populations and demographics. The second is technological revolution at a pace that governments can't even keep up with. The third is income inequality, which is exacerbating and causing more division. We've got these unprecedented levels of debt to deal with, and then also there's climate change, which we're only just starting to understand. Now, another book that we like by Simon Sinek called The Infinite Game, he argues that this is actually going to overwhelm governments, and companies are going to need to fill this void through stakeholder capitalism and ESG. Now, we practice this at Nicola Wealth through our share the pie philosophy, but also we would add that it's important to demonstrate leadership in areas of philanthropy, in equality of opportunity, and in sustainability as well. Daryl Bricker was a guest on our podcast in late 2020, and recently he joined forces with journalist John Ibbotson to write this book, Empty Planet: The Shock of Global Population Decline. The book is essentially summarized by this chart that you see from Statista. Okay, what this chart is trying to do is explain to you from today until the end of the century, how are populations around the world going to evolve? Some notable things stand out. The first is that China is already in population decline, and remarkably, by the end of the century, expected to decline by almost 50%. The fastest growing population growth is actually going to be attributed to Africa, and you can see that Nigeria is the green line sloped upwards. In North America, we actually have declining birth rates, but we have this strategic advantage of being able to rebalance our population through immigration. Not every country has this advantage. Japan, China, Russia, Korea, the list goes on. Now, there's a lot going on, and it feels like we're in the eye of a perfect storm. So the question becomes, is there any light at the end of the tunnel? To answer that, we're going to draw from an old friend who once helped us at a time of deep distress. What Sir Winston Churchill said to us was that a pessimist sees the difficulty in every opportunity, and an optimist sees the opportunity in every difficulty. So, where are our opportunities? We believe they are in asset allocation. What is asset allocation? It is the strategic mix of risk-based assets such that you achieve superior returns for lower volatility. So what does a good asset allocation look like? Well, why don't we look at some of the best investment managers Canada's big six pension funds, okay? So this is showing you the asset allocation of the big six pension funds. You've got CPP, Caisse de dépôt, OMERS, Ontario Teachers, BC IMC, and then also the public service pension investments. And as of 2018, 2019, 40% of their asset allocation on average was in private assets. And we know that the figures will report higher when they report 2022. The question becomes, how does this model actually perform? So we can see that the 5-year result of CPP, 8.7%. The 10-year annualized result, 10.3%. Ontario Teachers hasn't done so bad either, a 10-year result of 9%. Let's compare this to a proxy for your average balance fund, which would hold a combination of stocks and bonds in about a 60% stock, 40% bond allocation. Well, it doesn't provide much downside volatility, which then makes it justify a long-term 10-year return of only 3.82%, okay? Now, there's a group in London called Savills, and they endeavored a couple years ago to figure out how has the world allocated its net worth, okay? So they concluded that in 2020, the value of real estate was up to $326.5 trillion. And they figured this out by actually looking at all assets. And what they did was they included residential housing, and they excluded private equity. So we wanted to look at an adapted version of this. And so what we did was we actually took out residences because we want to know how is the world's investable assets allocated. And then we also added back private equity because there's a significant amount of wealth there. What we found, okay, was that multifamily was approximately 17%, commercial real estate 10%, farm and timberland 9%, public equities 20%, securitized debt, this means fixed income, bonds, mortgages, private debt, 28%. Gold has a 2% sliver, and private equity is 14%. So if we look a little closer at this, the question becomes, if globally the world has 36% in real assets, how then are you justified in asset allocation of having somewhere between 60 to 75% in the portfolio in stocks? In our view, it just simply doesn't make sense. And so that's not our model. Instead, we have more of an institutional style of management that includes a combination of public and private assets. And it really boils down simplistically into 3 main categories. We've got approximately 33%, 1/3 in investment grade real estate. Our fixed income exposure is 32%, and that includes both public and private. And our equity exposure, approximately 35%, public and private. How has this done? If you invested $1 million at the beginning of January in 2000, and you wind forward 22.7 years to today, and you had put your money into a basket of world stocks, you would have had 4.72% return annualized over that period. If you picked the S&P 500, 6.12%. The TSX did a little bit better. But if you couldn't stomach the volatility and you wanted some lower risk investments in there, you could have used that same balance fund and you would have achieved 4.5%. Our results after fees, over 7% annualized. And that included some pretty interesting market environments. In dollar terms, that $1 million in the 60/40 portfolio would have turned into $2.69 million. And with our model, it would have been $4.64 million, which is almost $2 million more on an initial capital investment base of $1 million. Now, long-term performance is interesting, but what about short-term performance? And specifically, what about short-term performance in the aftermath of peak valuations? So on this chart, what you're seeing is the S&P 500 PE chart. We've circled, notable peaks. One was in 2000, one was in 2008, and interestingly, the most recent one about 9 months ago at the end of 2021. What we wanted to do was know, how does our model compare to the 60/40 model? And what we saw in the 5 years immediately following these peaks is the 60/40 model delivered an average annualized negative return of 2%. We came in at 5.1, which is a difference of 7.2. In 2008, a difference of 3.2 every single year for 5 years. And it's a little bit early to draw any conclusions because it's only been 9 months, but significant difference so far. And the bottom line here is that real estate and private assets, they play a large role in outperformance when equities are expensively priced. Now, we also like the volatility characteristics of private assets. So the National Bureau of Economic Research teamed up with The Economist magazine, and they decided to go back 145 years and average out real estate performance and other asset class performance across 16 countries. And here we're going to look at just 2. How has real estate performed? Nominal return, so not factoring for inflation, 11.1%, with a reasonable amount of volatility. And how about stocks? About the same return, but with way more volatility. Now, constructing asset allocation might seem simple, but actually it's getting harder and the low-hanging fruit is gone. And the reason is because we're no longer in this easy money, decreasing interest rate environment. In fact, it's the opposite. Bond yields are increasing. We've got quantitative tightening as a result of the fight against inflation. You know, it's not exactly the case that you can argue stocks are cheap. They've come down, but they're not necessarily cheap. And then interestingly, as cap rates on real estate rise, you can end up with a negative drag effect on real estate performance, okay? So it is actually getting harder to construct asset allocation and add value. And the question becomes, how are we adding value? You know, for the entire existence of our firm, our main goal has been to deliver outperformance to our investors beyond what the public markets can offer. This is what we live and breathe every day. So what are we doing right now? Well, right now in real estate, we're focused on industrial and multifamily residential. We're repositioning assets by rezoning. We're looking at special situations. When I was 20 years old, I had about $1,200 of stuff, and I paid $200 a month to store it for 3 years, okay? You want to be on the other side of that equation. With build to own, you're also going to see it's an important part of our strategy, and we're going to talk a little bit more about that in a second. In terms of fixed income, we're focusing more on private assets, mortgages and private debt, where we can capture increasing interest rates more effectively than through the public markets. We're also using separately managed accounts to improve our flexibility in investment options and push down fee structures. And then finally, we don't have exposure to long-term bonds. Now, in terms of equities, we believe in directly managing the assets. And we have always been rooted in a value-based and cash flow-focused approach. But that doesn't preclude us from pursuing certain segments of the economy that we actually think are going to grow at a faster rate than the overall economy. And those include renewable energy and technology. Now, even real estate needs to be actively managed. And we've got a big team that Mark leads that does that for us. And we dusted off this old slide from 2010 to show what did our allocation look like then. High dose of retail, a significant component in self-storage, and our industrial was limited and multifamily residential specific to the US pool. And where are we today? 34% multifamily, 33% industrial, a little bit of retail, 7% self-storage, 16% office, and the other category is 7 with 2 of it in senior living. So, comparatively, we're currently at $8 billion in gross real estate assets, of which 4.3 is investor equity and the rest is strategic use of financing. Retail investments, we dropped over that period from then until now from 45% to 3%. This served our investors very well when we went through the challenging environment of COVID. We increased our exposure of multifamily and industrial from 12% to 2/3. This served our investors very well coming out of COVID. And build to own is now 10% or more of our portfolio, and it's a mainstay of our strategy going forward. Now, sometimes we're asked the question, why do you want to manage the real estate? Why don't you just invest in publicly traded REITs? The reason is because if we can manage the asset, we can prove we can deliver value. This is our Canadian real estate LP, going back to 2005, compared against the iShares capped REIT index. And you can see that over that period, the annualized return, we've delivered 3.2% per year more with significantly less volatility. In the value add real estate LP, we've added value to the tune of 9.4% per year more. And again, with significantly less volatility. And we've also done a similar, we've done similar performance on our US real estate LP, 2.8% per year more, less volatility. Now, real estate's not just useful in terms of its investment outcome, it's also tax efficient. Now, because we can depreciate assets, we can use that as an offset to reduce taxable income distributed to investors. Currently, in Canada, 50% of a realized capital gains is taxable and 50% is not. This next one, you have to check whether or not these specific circumstances can apply to you. However, in some cases, income from development projects may be taxed at lower rates in a Canadian-controlled private corporation, which would otherwise be taxed on passive income at rates of around 50%, okay? And then we can also defer tax. If we need to finance, we don't necessarily need to sell an asset to trigger a gain. We can refinance an asset rather than selling, okay? These measures are very important if you are in the highest marginal tax bracket, personally in BC, which is 53.5%, or again, if you're using a corporation or even income splitting through a trust. Now, how does this actually look in terms of, after-tax outcomes? If you took our value-add real estate LP at 15%, 50% in our US pool, and 35% in our Canadian pool, and you invested $1 million in January of 2016, by December of 2021, you would have $1.958 million. That $958,000 profit is an 11.9% before tax return. You would have paid around $76,000 of tax, so about 7.9%, and your after-tax outcome would have been 11.1%. Why do we do build-to-own real estate? And what is build-to-own real estate? Well, when we build a property, before we are using it for its management and cash flow return, we can capture the investment opportunity that development would otherwise realize in the first 3 to 5 years, and it's meaningful at around 15 to 20% per year. We can also build the kind of assets that we want. What's also nice about these properties is they have reduced capital expenditures in the first 10 years of the life of the property. And then also we can contribute to the global standard of sustainability in real estate. For multifamily, we get preferred financing rates, which is quite useful in this interest rate environment. And actually, there's no tax to pay on the transition of the use of the asset when you go from its development into its long-term hold for cash flow. So, ladies and gentlemen, there are difficulties out there. We are going to continue to pay attention to them closely so that you don't have to. And we're going to continue to relentlessly pursue opportunities and get you access to them. Thank you very much. Without further delay, I'd like to introduce Kevin Falcon, Leader of the Official Opposition, and Mark Hanna, Managing Director of Nicola Wealth Real Estate. And while they're getting settled on stage, we've got a short video for you to enjoy. Thank you, and have a good evening.
When I first got elected into government, Gordon Campbell appointed me as the minister responsible for reducing red tape. And the commitment we made to the public was to reduce unnecessary red tape and regulatory burden by 1/3 within our first 3 years. We did 42%, and I'm very proud of that. And one of the things I discovered being in government was getting big projects built is tough. You really got to drive them through and break down the barriers and the opposition and just make sure you stay focused to ensure that projects like the Sea to Sky Highway, like the Port Mann Bridge, the Canada Line, the Evergreen Line, all projects that I had the honor of advancing, get built. And then I got to spend 10 years working with Eric Carlson and Anthem Properties. And I really had a front row seat to just see how inefficient it is to get projects built in the province of British Columbia. Both local government and the provincial government conspiring together to make things virtually impossible. And yet I hear politicians constantly go on about how much they care about affordability. And yet all they do is add costs, delays, that all, conspire to create way more expensive housing than it needs to be. And that's one of the reasons why I want to be the next premier. Because I want to make sure there's somebody that actually understands the housing business, understands what it takes to eliminate unnecessary red tape, and gets results. Because at the end of the day, I think the public just wants to see results, not rhetoric, not empty promises, not pretending that bureaucracies and governments are going to somehow figure this out, but unleash the innovation and the expertise of the private sector to build the housing we really need in the province of British Columbia to deliver for the residents of BC. That's why I'm so thrilled to be part of this conference.
Kevin, welcome. Thank you for joining us today.
All right.
Yeah.
Thank you, Mark.
Very happy to have you. I know there's some people at the back. There are some seats up front, so feel free to come up if you want a seat.
This isn't church.
Yeah. Speaking of big projects, we first met around 6 to 7 years ago when we were serving on the Lionsgate Hospital Foundation board. And that was right after you left public office, and you were probably happy at that time to take a break. And I got a front row seat to learn how critical it was to navigate a major capital hospital expansion program, and having you there with your insight was invaluable for us to make sure we made all the right moves. And similar to other major capital projects going on with other hospitals such as St. Paul's and Burnaby General, I think it's a great example of how the private sector can work with the public sector together to get some good outcomes. So these are very troubling times. We're getting a steady dose of a stream of bad news, and I don't recall a more troubling time in our province in my lifetime. There seems to be so many issues, Kevin, and there's so many challenges. If you talk about healthcare, there's shortage of nurses, deteriorating emergency wait times. Many families don't have a family doctor. The opioid crisis is getting worse by the day. Gang violence and property crime, it's on the rise. There was a headline in the article today, and you were quoted on it, in terms of the chronic offenders that just keep getting put back on the street, trying to find a solution. I could keep going, but it is very depressing. And I'm not trying to blame the current government, because some of these issues, not all, they would have happened anyways. And when I look at, from my perspective, in what we pick a leader to do, it's not blaming you for what happened. It's how are you going to deal with those issues. So, are you sure you want to do this? Be the premier?
Well, after listening to that, I'm not so sure now, actually. But yeah, no, I am. But because at the end of the day, I do think that leadership matters, in the sense that there's always going to be challenges in government. So first of all, don't run if you don't like to deal with challenges. But I think there's huge opportunities too, if we focus on outcomes. And I think the biggest challenge I see in government is that they focus way too much on what they're putting in, not what they're getting out of it. And so you'll see government often, spend more money, double down, do more of the same thing, expecting somehow they're going to get different results. It doesn't work out that way. But unfortunately, too many people in government haven't figured that out, and so we pay the price.
So all those issues I mentioned are very important, but we're not going to talk about those today. It's a real estate event. So I've got a series of questions relating to real estate topics that I want to run by you and get your input. Maybe I'll start with the first one, which is obviously getting a lot of news in the headline, and it's a serious issue, and it's really that homelessness has been well documented in the media, not only for the downtown east side, but it's spreading to Gastown, downtown, and other areas of our city. And it's not exclusive to Vancouver. It's happening in Kelowna, it's happening in Victoria, and it's happening in other communities. So it's certainly a big concern. And I know it's a very complex issue because it's impacted by mental health, addictions, and other social issues. So this is having a very negative impact on several areas, local businesses, public safety, and tourism, which is a big part of what happens in BC. So what do you think we can do on this topic?
Yeah, well, this is one that's very close to my heart. So I spent 10 years on the board of the Street Home Foundation that works to try and deal with the issues around homelessness. And I think probably the greatest contribution we made was really drilling down deep and trying to understand who are these folks and what issues are they dealing with and why are they there, and where are the gaps in the services that are trying to be provided. And honestly, I can tell you that after watching things over the last decade and seeing the rapid deterioration, I can almost say that virtually everything we're doing is going in the wrong direction. And yet, going back to what I said earlier, the crazy thing about government is government will continue doing more of the same. Mm-hmm. And even though everyone can see the situation getting much, much worse, government will just keep, going down that path. And I think we need a dramatic shift in direction, I have to tell you. I think it actually goes back decades when governments really across North America made a decision to say, we are going to stop institutionalizing the mentally ill and we're going to start releasing them back into the communities. And the idea was they were supposed to have supports. But the problem is the supports were never really there. There was no real follow-up. And if you track the deinstitutionalization of the mentally ill, you'll see a corresponding increase in incarcerations and homelessness, North America-wide. Now, the problem is, I think we have a whole series of policies here, specific to British Columbia, that are just making that a lot worse. I think we're rapidly going right down the path of becoming the next Portland, San Francisco, Seattle. And if we don't change direction in a big, fast way, we're going to get exactly the same results we're seeing right now, which I think is awful. So what do? Two things. Number one, I think we have to, in a very compassionate way, take the mentally ill that have been left on the streets to their own devices, which is horrible because they're exploited, they're abused, it's terrible. And we need to take them and put them in genuine 24/7 care with proper psychiatric and medical supports. And I think, thank you. And I think we owe that to these folks because remember, every one of those people you see out there is somebody's son or daughter or sibling or parent. And we often forget that, because they get characterized differently. And that would be step number one. And I just think we owe that duty of care. And step number two is our treatment of addiction. We have to invest in treatment and recovery. The only place they're doing it really well in this country, as far as I'm concerned, is in Alberta. In Alberta, they've seen a 47% decline in opioid deaths. BC, every single month, it gets worse and worse and worse. And yet government is doubling down on the same old program that they've been having: decriminalize hard drugs, provide safer drugs. All these directions they're going in that are getting terrible results. And I think we have to look at a different approach that focuses on helping addicts get into treatment and recovery. That ought to be our number one focus. Recognizing that it's never a clear path. There will be stumbles. Addicts will continually have failures in their path to recovery, but that's okay. That's part of the process. It's like, if you've got a health injury, you deal with it and you get going. We have to do that.
I'm sure the mayors coming up for the municipal election, they're all having to deal with this topic, but it's not something they can deal with on their own. It's really going to need the help of all three levels of government. And I'm pretty sure this is going to be a hot topic in the next provincial election. So moving on to the next question, this was in the headlines, I think 2 days ago, that BC has the dubious honor of being the #1 highest national ranking for unaffordable housing. That's not good. Affordable housing is just something we need to solve, and we need to do a better job at providing reasonably priced, affordable housing that is closer to work and to reduce those commute times. So can we not be more creative and explore tax relief for financing? Like, I think we saw 3 weeks ago that the federal government gave a tax-free loan to the Squamish Nation's Kitsilano project, which is great, right, to encourage. But I mean, those are the kind of things we need to do to incent developers to build affordable housing in a timely manner.
Oh boy, yeah, this is a great question. So. Look, very quickly, I think we have, and I'm sorry if this sounds partisan, folks, but I got to be honest with everyone. The new government, the NDP government, went in their first term in 2017, the first thing they did in their first budget was layer on a whole blizzard of new taxes onto housing. And their thinking was that this was going to deal with the affordability question because they improperly characterized the problem as foreign Chinese investment and the fact that developers are evil and they're getting rich off the people. And so here we are, 5 years later, they're in their second term. Let's do a gut check. How are we doing? Well, like you said, we've now got the highest housing prices in North America. Okay, third highest on the planet. So that is a total policy faceplant. And the problem is they ignored the really critical aspect of that, which is the supply side of the equation. Now, only recently are they talking about, oh gosh, I guess we should deal with supply. And I'm sitting here thinking, well, no kidding. But it would have been nice if they started a long time ago. So what is the answer? The answer is to recognize that the biggest barrier to getting supply into the housing market is government itself, at the local government level and frankly at the provincial government level. And the two conspire through their own incompetence to actually create a terrible situation that drives up the price of housing. And So what would I do differently? Well, first of all, I've been very clear. I was just speaking up at the Union of BC Municipalities, and I said a Kevin Falcon-led government would bring in legislative change to ensure there is timeliness in the approval process. And I would also hold local governments to account to make sure that they get that new supply into the market through incentives and disincentives. Those that aren't doing their bit, they're going to feel the financial hit. Those that do their bit, they're going to be encouraged to do more, and there will be financial benefits to doing so. I think that's really critical. I also think it's critical that the province may have to, and will in fact, have to step in and say, you know, when we're planning big transit corridors, existing or future ones, we're going to actually make it really clear up front what the zoning is going to be, and it's going to be dense. And there's going to be lots of new rental housing, market rental, affordable rental, condos, you name it, but there's going to be lots of it. We need to flood the zone, if I could use a hockey analogy, because until we do that, we are not going to break the back of affordability. So it's going to take leadership at the provincial level and at the local level. And the final point I'll make, because I don't want to go on too long, is that I get really frustrated with politicians that talk and profess to care about affordability, but everything they do works against affordability. You know, you just go through the list of CACs, DCCs, property transfer tax, PST, GST, and public art fees and charges and everything else, and then the time delays. How did we get to a situation in the city of Vancouver where it can take longer to have a straightforward residential tower zoned in the city of Vancouver than it took for us to fight and win a world war? It makes no sense to me.
Are you talking about those? When you're talking about those developers, you're talking about my panel over here?
Look, the developers get blamed for everything, but the reality is, at the end of the day, government needs to look in the mirror. I really believe that. Government needs to set the table and recognize. I'll give you one more example, Mark, if I could. The NDP government got elected and said, we're going to build 114,000 affordable homes in 10 years. And I thought, that's ridiculous. There's not a chance they'll build 100. And every smart developer that I spoke to all laughed when they said that. Yep. You know, well, sure enough, here we are. We're year 5, again, second term, halfway through. How are they doing? 7%. Yeah. 7% of the units promised. 40% of them were started under the BC Liberals. Government's not going to get us out of this. We can set the table, create the right incentives, get the private sector to do it. That's how we're going to build it.
And that's a good segue.
Hey, this is a great crowd. I should come here more often.
Friendly.
I don't get clapped at very often, by the way.
I didn't think they clap for politicians anymore. That's a good segue into the next part. The next question is really on approvals. And the federal and provincial governments, they really talk a big story about wanting to provide affordable housing, yet they are all working in silos, at least from my perspective. This also includes senior housing, because there's a lot of seniors that aren't going to be able to afford private independent living. They're going to have to go into the public system. So we need to think about that as well as our population ages. So approvals by municipalities for new projects, they're taking way too long. It is ridiculous. Mm-hmm. So notwithstanding the perception that you mentioned of that developers are greedy and make massive profits, the reality is developers take on a lot of risk on a project. I mean, there's so many things they're exposed to in a cycle that could take 5 years from start to finish. It could be, cost overruns relating to interest rates, labor, and materials. And in addition to that, as you pointed out a minute ago, the governments, they're getting some healthy development cost levies. Mm-hmm. So you'd think the municipalities would be motivated to spur the process. So my question to you is, the municipalities get blamed for this, but I think I really look at all 3 levels of government. Like, how do we get through this red tape? How does the 3 levels work together to get speed to market for the product? The developers want to provide it.
Mm-hmm. Well, look, I think that at some point somebody has to say enough talk, right? Because people have been talking about this issue for years and years and years. And like I said earlier, I'm just tired of politicians at provincial level, local government level, standing up and professing they care about, affordable housing when everything they're doing is working against that. You've got different step code requirements in every different municipality. All of that adds huge costs onto housing, by the way, for, again, a good objective. Everyone wants to have a greener future, et cetera. But on the other hand, we better acknowledge that we're adding a lot more costs onto housing. And delays, again, there's a cost to capital. And I don't think there's many people in local government that have any appreciation of that. The time actually does equal money.
but they don't care. All the incentives and disincentives are wrong. So we have to change that. Very directly, I do think the province needs to take leadership. I rarely say good things about the NDP government, but when David Eby finally realized that supply is part of the problem, he started talking about, he wants to make changes. The concern I have, though, is because he has no background in the private sector, that the changes he drives through aren't going to end well. I just don't think he'll get the mix right. At the end of the day, look, developers just want to go out and build and develop and do what they do best. They wake up every single day thinking about how they can get something done faster, cheaper, and more effectively so they can sell it and beat out their competitors. And we have to harness the genius of what the private sector does best to deliver what we need for a public good, which is a lot more supply into the marketplace. And that's something that I am absolutely committed to make a #1 priority, because I can tell you this, right now, today, 75% of young people have given up hope of ever owning a home in British Columbia. That's not the British Columbia I grew up in. That's going to change.
Yeah, I agree, and a lot of them are going to have to rent for a long time. It's not just the down payment, it's now, with high interest costs, it's servicing the monthly debt.
Sure, and yet on the rental side, what did government just do? They just capped, inflationary increases. So now you've got landlords that are capped at 2% while they're facing 6, 7, 8% inflationary costs. What's that going to do to attract new investment into rental housing? Nothing, of course. It'll work against it. So, again, we just have to have smart policies that can help renters directly, but stop punishing the landlord side so that we can get new supply into the marketplace, which we desperately need.
If you had new supply, it would sort out all the pricing.
Absolutely. That would actually really help renters.
Yeah.
And government doesn't get that, and we need people that do get it.
Okay. Moving on to the next. Sorry I missed your ribbon cutting ceremony for the new bridge that would have been completed in 2022 to replace the Daal tunnel. I'm sorry I missed that.
Yeah.
That was very cute. I saw that you on TV cutting the ribbon for the bridge that's not there.
Yeah.
Yes, that was good.
I kind of like that too.
That was very good.
Yeah.
It was very creative. So even with an impressive SkyTrain system that I think is the envy of North America here, we still got traffic congestion here. So I think it's still going to be important to deal with traffic congestion, because how do we deal with that?
Sure. This is so important, because I was lucky that I was a Minister of Transportation under a great Premier named Gordon Campbell. And Gordon Campbell had a great vision for infrastructure. We're sitting in part of it right here, right? And part of that was a recognition that whatever we think we have to do, we actually should do way more. Because first of all, we're a growing population. You just look outside these windows, and there's no surprise that people around the world are saying, hey, this would be a pretty good place to live. It's got a stable, relatively stable government, and it's a beautiful place to raise a family and build a business. But we have to make the infrastructure investments to meet the growing demand of people moving here. And what drives me crazy is when we have government that doesn't understand that, or does things like cancel that 10-lane Massey Bridge. I just want everyone to understand that 10-lane Massey Bridge that was planned and started under the old BC Liberal government. I wasn't in government at the time. It was Christy Clark's government. But that 10-lane bridge, $100 million had already been spent on preload, moving power lines, and they went through a full procurement process. They had a winning bid that was $900 million below the budget of $3.5 billion. They were shocked, actually. It was an amazing deal that they had in place. All they had to do was just sign it off, and they were going to get started in construction. And unfortunately, when the NDP won government, they canceled that project. $100 million just got flushed down the toilet, and worse still, they lost the opportunity of that bridge with all the fixed prices they had in place on steel and all the costs that have gone up dramatically since then. Now, so what we lost was a bridge that would have been open right now. And instead, what we're going to get, apparently, is, if they get a chance to go ahead with it, is an 8-lane tunnel that would have 2 lanes dedicated to buses and 3 lanes in each direction for commuter traffic, which is exactly what we have today when the counterflow is in place. And the 10-lane bridge would have had 2 lanes dedicated for buses, but 4 lanes of commuter traffic. But most importantly, it was designed and engineered to allow for a future SkyTrain to connect the Bridgeport SkyTrain station in Richmond right up and over into South Surrey. That's the kind of planning and thinking ahead we need to do. And what I see happening right now is frankly terrifying. The Patala Bridge, many of you know that, it was built in 1938, an 80-year-old bridge, 4 lanes back in 1938. My God, the cars in 1938 were, it was like the old Fords and stuff like that. And yet they still had the vision back then to build a really big bridge. Today, the government's replacing that 4-lane bridge with a 4-lane bridge. Yeah. And that's just like, I'm sorry, it's madness.
Hey, we got a 3-lane bridge here going to the North Shore, so.
Yeah, don't get me going. But anyway, my point is, we have to think for the future. And, you know, building the Canada line was actually really hard. Yeah. But the reason we went ahead with it, in spite of the opposition from the NDP and in spite of opposition from some local government leaders and mayors and this and that, we still drove it through. And the reason we did is because 100,000 people every day are using that instead of driving their cars. So the thing we have to do is do way more of that so that we can pull more people out of their cars. It's good for the environment. It moves people around quickly. It makes Vancouver, it's easier for workers to get in and out of Vancouver. It brings, you know, suburbia nearer to Vancouver, and it just makes it easier for everyone. But it requires a real commitment to getting it done.
I'm going to move on to the next question, which is ESG, favorite topic for a lot of people. It's very popular. And you know, you and I had a chat a few months ago about the Site C Dam, and I want to work that into this. You know, I asked you, like, if with all the things we want to do here, you know, could we do it without the Site C Dam in terms of powering it? So let me go on with the question here. So what is an emerging trend with ESG is certainly building net zero carbon buildings. That's very active right now. So in addition to what the National Building Code requires to build a new building, other things that people are doing to make it net zero carbon qualified is rooftop solar panels, triple pane windows, electric power versus gas. Those are things that get you to that net zero carbon, and that's the direction we need to go. But so, you know, it's probably lucky that your government, when you're there, supported building the Site C Dam, because how could we meet all the future demand for if we want to go electric for cars and other things? So we need to all do our part to fight climate change, but I think also more education is required on this topic. A lot of people they know it's kind of there, but we need to really get that message out. So how does the provincial government approach environmental sustainability?
Sure, and that was a controversial decision. Frankly, anytime you try to build anything in British Columbia, it's going to be controversial. So it's really important that you do your homework, and when you make a decision to go ahead in a project like that, and I was there when we launched it and announced it in 2010 up in the Peace Country, and I was very, very proud that we did that, and we really dodged a bullet because you know, it moved forward, and it was, I think at that point when the NDP got elected in 2017, I think about $4 billion was already into the ground on this project, and they were literally debating. Yeah. They actually stopped all the construction and spent almost a year trying to figure out whether they wanted to go forward with it. Now, fortunately, they did. I would give them credit for that, because believe me, we are lucky that we had W.A.C. Bennett that built the dams back in the 50s and 60s that have given us, you know, I mean, decades ago. It's amazing, the vision and leadership that give us, you know, 98% of our energy is renewable because of the dams. And building that dam with the growth in electric vehicles and everything else, my God, we'll need all that power and more. And so it is going ahead. The delays obviously caused a huge run-up in costs. It's doubled the budget, frankly, from $8 to $16 billion.
But we can survive without that. We would have to have that down.
But I was just up there a short while ago, about a month ago, and touring through it, and it is an impressive construction job, even with the cost inflation and everything else, and some of the mismanagement that went on. But it is pretty spectacular, and it will get done, you know, unless the person running for the leadership of the NDP right now who wants to shut it down. I'm not sure how you do that after. You know, frankly, we're probably into it for about $13 billion, but anyhow, I don't think that'll happen. It'll get built, and thank goodness it will, because we need those kind of long-term decisions.
Okay, last question, and then we're going to invite our other panel members up. You have the benefit of working on both sides of the fence. You worked in the public sector, and you came back and worked in the private sector in real estate development. So it really provided you with a really unique perspective on how both work. So some of the issues we've talked about today, and we referenced the hospital foundation, the foundation from the private sector working with the provincial government to get the hospital expansion done at Lionsgate in North Vancouver, and that's happening in other hospitals here. How do you think, if you're Premier, that the private sector can work with the public sector to do other capital projects?
Well, it's a great question, and the way actually the hospital foundation that we both sat on together is a really good example. You know, we have a CEO there Judy Savage, who's just fantastic in understanding how important it is to have a group of really good people sitting around the table to help guide decisions around raising huge amounts of capital and ensuring that when they work with government that it's structured in such a way as to protect the interests of the people that have donated and ensure that these projects get built. That's one thing that we can do going forward in government. If you look at, you know, the housing corporation, BC Housing Corporation, that the, you know, Minister Eby until recently just fired the entire board. Well, it was a board they appointed. Why did they fire them? Well, because frankly, they were interesting people, social activists and other folks that have a lot of interesting backgrounds, but not much experience in real estate. But they've got them overseeing a corporation with $2.8 billion annualized budget and huge investments in the real estate sector. And not surprisingly, they didn't know what they're doing, and it's turned into kind of chaotic situation. So what can the private sector do? The private sector can help serve on some of these boards and give, you know, there's good professional civil servants in government, but they haven't got the private sector experience that we can draw on and bring into a lot of the crown corporations that are trying to achieve some public objectives to provide that oversight and that insight that is so needed in government. That's one of the first things I would do. I've always believed that if you get really good people willing to donate some time to help government achieve its objectives, you will get really great results. We tried to do that while I was in government in the past, and that's certainly something I'd do going forward. So some of you folks, we may tap your shoulder one day, so I hope you'll say yes when we do so.
Kevin, that was great for you to share your thoughts. I do want to invite you to stay on. I'm going to invite our other panel members to come up, and I'd like you to join in the conversation.
Sure, be happy to.
All right, thank you very much.
Thank you.
Okay.
Thank you, Mark.
I just joined a rock band. That's actually how I ended up at Reliance. I was in a rock band with the founder of Reliance's son. Then I got to know the owner and initially started doing accounting for the company back in 1983. I've been president for about the last 10 years or so. Our initial image was around all the heritage work we did, but since then we've gone on to build much bigger projects. Just today we're finishing one of the biggest projects in downtown Vancouver. You know, it was kind of an accidental situation getting started in real estate, but I always liked it. I can drive all over the city and drive by buildings and go, you know, that was just a twinkle in my eye at one point, now it's a building. And I like the tangible nature of it. That's always attracted me to it. Just kind of doing it, it's just fun.
My grandfather was a carpenter, and my dad was an architect. As kids, we would build forts in the backyard out of old crates and leftover bits of wood. And we had just developed an affinity for the intersection of sort of humanity and space. I combined that with, I knew when I was 12 years old I was going to be self-employed. It wasn't about a well-calculated move, it was more just like, if I don't do it now, I'll never do it, and I just did it. It was tough. I look at Anthem as a whole, whether it's capital, diverse sources of capital. Real estate, diverse asset classes, diverse activities within that, people doing the work, diverse people. This need for diversification is a huge element of who we are.
I think when you come from an East Indian family, you live and breathe negotiations. You're cultivated to be an entrepreneur. It's just, what is your threshold for risk? People will tell you I am fiercely independent. I didn't want to be part of the family business, and so I went and worked at Colliers for about 4-ish years. That followed and was led by me doing a couple of deals, and it just went from there, and I just started to buy assets, and Lotus was created. As a small company, we're unique to the extent that we have actually played in all the asset classes. We started off with commercial deals. In the last 5 years, our focus has been multifamily and industrial. It's always different. There's no certainty to what the day will look like, and there's always an interesting problem that requires a solution where we sit with the team and we talk about what's going on. Everybody goes away to get information, comes back, and we work as a really tight unit. And that's why we're successful. I think real estate, it's part of every single thing we do. And so for me, it is the fabric of how a city is formed.
I started in real estate as a co-op student. I spent 16 years at Bentall, and we grew our relationship with BCIMC from $900 million at the time to about $16 billion. And then we ultimately took that whole portfolio and used it to create Quadro. You never really appreciate what somebody can do until they're given the opportunity. And in the case of setting up this company, Many people who had done the same thing for many years were asked, hey, step out of your box and create something new. Quadrill's biggest contribution to its ultimate stakeholders in BC is paying pensions of 600,000 BC public employees. And if we get that right, then nothing else really matters. So that's a pretty high bar, taking care of money for others, and we take that very, very seriously. At the end of the day, my number one focus is how do I get people to be their best? That's my role. I can't do it all, and I don't want to do it all, but honestly, if I can facilitate an opportunity, if I can help them reach their potential, then I'm doing a good thing.
I say that if you ever think that you've made it as a company, that's a dangerous place to be. I think we have to always maintain our curiosity about what haven't we done well yet. I call it the quest for the Holy Grail. You never get there. You pursue goals, you get to the goals, you set new goals. But it's very important to maintain the quest.
It's hard to watch yourself on TV, isn't it? You all perform very well. Thank you for being here today, and thank you for your patience for the final act. We're lucky to have such a talented group of industry experts today to join us on the panel. And I hope you don't mind, I've asked Kevin to join us. You're all good with that? Yeah? So a couple things jumped out at me about the video before we launch into the questions. Eric, you've come a long way building tree forts to building towers. Jon, coming from a rock band to running a large real estate company, it's not a normal career path.
That's what I tell all the kids to do.
Yeah, start there. Shenoor, you managed to escape the real estate brokerage earlier than I did, right, to start your own company. And Remco, starting as a co-op student and running a $60 billion company, that's probably not how you drew it up, right? So before we go into the questions, there's one topic I want to throw in here that I think you'll probably all be consistent on, is it's about people. And Kevin, this is going to apply to you too with building your team, real estate does not run on its own. You can buy it, but that's actually where the hard work begins. So it requires a talented team of specialists. So how important is that for you? And maybe Shenoor, I'll start with you and we'll just go down the line here.
So our investment focuses on value-add properties, not so much on the development side. We're not a merchant developer like my colleagues esteemed here. So our team is heavily focused on asset management and being able to reposition assets and create value. Without them, we're nothing. And so everything we do is on the asset management side. It's the quality of the people, their commitment, the day-to-day activity, and executing that plan in a way that provides oversized returns, because we do few deals. We're not a very scaled organization, so it works a little bit differently.
Jon?
I think, our company's roots are, a traditional family holding company, the old school Vancouver approach of kind of accumulate and hold. And I think people at that time were kind of a necessary evil, like someone had to open the envelope and deposit the check. And it's been a really tough transition for our company to change the culture, to get an understanding across the whole ownership spectrum that to do the type of work we're doing now, like people are essential. And we've made some really good progress with that, and it changed the culture of the company a lot, but it has been a challenge. And real estate didn't used to be a business that talked a lot about people. It talked about bricks and mortar and roofs, and it didn't talk about people, but now it's absolutely key.
I agree.
Yeah.
Remco, if you're running a $60 billion portfolio, how many staff do you have?
Our company's 1,200 people today. We're vertically integrated in Canada, so property management, leasing, development. So roughly 750 folks here, and the balance are international. So it's a pretty big group of people, and when you think about it, we started in 2016. So we went on a vertical program of hiring and bringing people into 7 offices in Canada, New York, London, Hong Kong, and most recently LA. So big group. I think the only, lesson I've learned in the process is, people will come with you on the journey as long as you communicate. And as long as you communicate constantly and you keep telling your story, and when you're completely sick of telling the story, communicate again. Yeah. Because that's the only way you're going to get people to be on side, believe you, and have the energy and enthusiasm. And in building something, you can't create it by just buying computers and figuring out how to pay people. You have to create a culture, which happens whether you create it or you don't. And communication is key.
Yeah. Eric?
Well, I'd like to agree with whatever everybody else has said so far. I have to admit, when I started in this business, I really didn't like people that much. I was fairly transactional in the 1980s. If you want a friend, buy a puppy. We're here to do a deal, right? And that was fun when we had 2 or 3 people who were obedient. and then it evolved into sharing ideas, and lo and behold, you have a portfolio that has to be managed by people, like Remco was talking about. And then you realize that if you actually listen to people, they're actually quite interesting, and they have ideas. And it allows you to get scale and get things done. So starting in about, sometime in the late 1990s, that nice soft decade after the hard 80s, we started really focusing on culture and shared values and best practices, and it created huge scale. And the thing is, I like people. They're great. You can do stuff with them. So we're all over it. We're a people company.
Kevin, you probably learned a few things working at Anthem, didn't you, from this guy, huh?
Yeah, no, for sure. I mean, look, I think people and culture are everything. It's in public life, the only thing I'll say, folks, is that please, if you see good people, support them. It's very tough to get good people to run for office. Why would you? I mean, honestly, it's crazy. Even me doing it seems crazy sometimes when I think about it. But it's especially tough to attract good women. Social media has created a very toxic environment out there. There's idiots, frankly, that sit in basements and have nothing better to do than to, make stupid comments about people and stuff. And unfortunately, fortunately, I don't spend time reading that kind of stuff. So I'm oblivious, but some people do, and it's hurtful, and it's unfortunate because we need to attract really good people into public life. If we can't get good people to run, then we get what we deserve. And unfortunately, you can see the impact of that almost everywhere.
And people helped us in our career, and we got to give back, and we got to mentor those people. Mm-hmm. That's a big thing we got to give back.
Yeah.
Okay, let's launch into the questions. So I've got, depending on time here, 7 or 8 topics to cover, and that covers really a number of different asset classes. So I'm going to start with one of you, and then I want others to just join right in, have a conversation until we need to move on to the next question. So the first one is on interest rates, a very hot topic. Over the last few years, I think we've been spoiled with a very low interest rate environment. I think the young people in my office think that's normal. That is not normal. That is what's happening right now is more normal in that interest rate range. So obviously over the last 6 months, interest rates they're on the rise to help stem inflation. How has this impacted the real estate markets in your sector and what you do? And how will this impact cap rates, property values, debt leverage that you might use in the short to medium term? And if the all-in borrowing rate is, say, 5.5% to 6%, are cap rates going to 8.5%? So maybe I'll start with you, Shenoor.
I think we talked about this at the beginning. So I think that, look, interest rates were always a little higher than cap rates were, especially in the Vancouver market. There just isn't enough supply. And depending on what kind of investor you are, either you are a flipper and you're coming in and out, then you're fully sensitized to this market. And I don't think that that's the right route right now. I think it's a time to look at assets, good assets, on a long-term basis. And, will interest rates stay at 5.5 or 6? They'll probably come off. You're at an inverted curve. I think it's affecting all the asset classes. Any brokers that you speak to, you don't see that the trades are happening right now. We're seeing a little bit of stagnation in the market, especially here in BC. Alberta's got momentum, but it's also got a little bit more, and the legs are there in the economy. And then out east, we're actually, spending a bit of time on the industrial space, and we're seeing cap rates move. The market seems to be responding to the interest rate environment. Vancouver's always the last to respond, but it also has the least amount of returns, and the people who invest in this market are in it for the long game.
I think most of us on this panel use debt. Maybe Remco, you lend money, but you can pay cash. But Jon, for your group, you use debt, right, for your developments?
Yeah,
big
sure.
part of what you do?
The first thing that you notice when rates go up is, and like I'm old enough, unfortunately, that I've seen that happen before, but is it just slows everything down, because just about every company, private companies, working with a sort of a limited pool of working capital. So you've gone from being able to move projects ahead with an appraisal surplus from a rezoning to have to put a lot of capital in. So for everybody who's got a pipeline, it just slows things down. It slows down the pace of development and the pace of launches. But it does, in our company, we can pivot a bit to build to core, build to ownership, because we don't need to perfect that exit. Like if it's a condo and you're pre-selling based on people exiting, being able to finance homes, that can undermine that. But if you're building to core, you don't have to sell at that perfect cap rate when you're done. If you can afford enough mortgage debt to pay off your construction, minus whatever equity you had to put in, then you can go long-term on that asset. So we find ourselves shifting the focus to build to core, especially if we're sitting on a historical or older land cost.
And Remco, you have the luxury of having a huge capital source, so you don't necessarily
use
debt.
I mean, we're still looking for returns, right? I mean, right now it's about the scrutiny of where do you go in a rising rate environment. You're looking for the assets that are going to provide you the best inflation protection. And specifically, I'm referring to multifamily and non-rent controlled jurisdictions. So if you build a new tower in Toronto, by way of example, you're not subject to rent control. And that's a nice place to be. And your rents are popping significantly more than inflation. If you build one in BC right now, you got a 2% cap. That's a disincentive. That's a problem. If you build industrial in the US or in Canada, obviously there's no rent controls on industrial. The demand is still really, really strong. Vacancies are 2%. You can get above inflation increases. So we're in all the asset classes, but we press the gas pedal on the asset classes that are going to deliver the above inflation rental rate growth and back off on the others. We're long-term investors. There will be changes in the cycle, but that's where you spend your time.
Eric, you don't use debt, right? You pay cash for everything.
I love debt. Yeah, financial leverage is my favorite subject in finance. Look, I think interest rates are a little overrated, which is a dumb thing for me to say, because I graduated from university in 1982, and the prime rate was 23%. Try getting a job in real estate. I had to become a chartered accountant. So yeah, it's a good reason to not like interest rates. So there are costs, first of all, right? So rates go up, and we got used to those low rates, but they haven't gone up like as a function of the entire capital stock or the cost to build a high-rise or a house. It's an increase and it's a pain, but it's just one thing. Labor is going up, materials are going up. There's other costs that we have to manage. But these interest rates, they mostly affect our expectations, they affect our behavior, they affect our perspective and our fear and our tolerance for risk. And so it does things like it slows down absorption of housing. People think that because mortgage rates are higher, that price of housing will come down, so they're going to hesitate to move into the market while they wait for things to settle down. And so it creates all these sort of tail whip effects. And I think that's the bigger issue. And I think that's actually what the central banks are hoping for, is that people slow down and it sort of suppresses aggregate demand to some extent. As it relates to cap rates are only very loosely, I think, correlated to interest rates. It's not necessarily true that when interest rates go up, the cap rates will go up. Cap rates is a shorthand measure of a return over what you're willing to pay for an asset, and it's based on the cost of capital. When interest rates go up, cost of capital goes up a bit, but does the cost of equity go up right away? Does the other types of capital, does their cost go up? And it also reflects the income you expect to receive. Well, one of the things that happens in an inflationary environment when there's a restriction on supply is rents go up. And when rents go up, you get a higher return, so you'll pay more for those future rent increases. And so when you do that, the cap rates will keep cap rates down. So I think cap rates will move a little bit, but not near to the extent that we're seeing the discount rate, the central bank's discount rates going. But I think it will work itself out.
Certainly in the discussion I've had with many colleagues in the industry is that they don't see cap rates going to 8%. They see them going up a bit, but not like 200 basis points above the prime borrowing rate.
Yeah.
So Kevin, my takeaway from this group is that they need interest-free loans from the provincial government so they can build projects, right?
It's your money.
Especially rental.
Okay, housing. I'm going to start with Eric. China has 65 million vacant homes. Vacant homes. We don't even have 65 million homes in Canada, I don't think.
We don't have 65 million people in Canada.
Yeah, we have whatever it is, 40 million. Or, So, with immigration on the rise in Canada, we got a real serious housing shortage. We've been talking about, like in our discussion with Kevin, this has been going on for a number of years about the governments wanting to, provide more housing. So, how do you see the residential condo and the residential apartment markets, the new product that is, how can it help, and what needs to happen to get that product to the market? And the other thing we should probably talk about is, how do we incorporate affordable housing into market housing? We already are doing that with projects, but how does that fit in?
Wow. Okay, so just to start off with the affordable housing, or the housing thing, we have essentially in Metro Vancouver, and in most cities in Canada, a very low vacancy rate. Like most houses are occupied. I know there's the rhetoric about the empty houses in the British properties and Shaughnessy and all that. But by and large, the housing stock is full, vacancy rates are zero, rents are going up. That means that there's a lot of demand for it. And we have higher interest rates, it's getting harder to afford housing, and we have the whole affordability thing because it's so expensive to buy houses here. I really don't know what's going to make it go down, because if the land is free, to build a high rise, you still need $950 a square foot to make it work. Right? And, I go, the carpenter's going to take a cut in wages? I don't think so. Is concrete going to get way cheaper? I don't think so. Copper wire going to get cheaper? I don't think so. So I think the risk is that we get stuck. The people won't pay what it takes because they think prices are going to come down, so we'll just get stuck. But then the people that keep moving here or are born here, they'll be competing for rental stock, or they'll stay in their parents' basement until they're like 47, playing video games, smoking weed that's legal, self-actualizing, making the parents real happy, So I think that's the danger. But I think that more than likely that kid will want to leave the basement when he's like 33, and will suck it up and pay what it costs for the housing at the expense of other things. And so, maybe people don't spend as much on going out for dinner or buying cars. They'll reallocate where their purchase price to get the housing that they need. Because it's so expensive, there's this whole notion of affordable housing and what that is. And essentially, in Metro Vancouver, it means that you're going to build rental housing that's going to go for rent that's 80% on average of the average rental price in a geographic node as defined by CMHC. And governments are mandating that when you build new housing, you have to build this affordable housing. Well, if that's the case, if you're only getting 80% of market, then you're subsidizing that project as a developer, or even as the public sector, with the value that you're getting from the market housing, which means they're going to drive up the cost of that market housing. Somebody has to pay for it. It's not free. And I don't think we've really necessarily connected that dot. But what how do you get the affordable housing is that in order to get the zoning to build the new multifamily development or the new housing development, X% has to be done as affordable, and that somehow that will work in the end. I think that, I don't know, it's kind of an experiment right now. I don't know really how it's going to work out. The one cautionary comment I'd make is that we all seem to think that the people who live in affordable housing are like school teachers, first responders, firemen, like people who just need a bit of a break to live in their communities. And I'm hoping that that's the case, but I think that there's all these different rules throughout the whole region about who can own it, how you have to run it, who can live in it. It could end up being kind of messy, so we'll see.
Remco, you've got, as you said, all asset types in your portfolio, and residential is a part of it, and you're active, so.
Yeah, it's tough. I mean, I hate to kind of harp on it, but, you could back up the truck in the institutional universe for multifamily. It is the perfect inflation hedge. It's a great asset class. We love it. We now have more in the U.S. than we do in Canada. We'd love it to be the other way around, but it's just too much red tape. You buy a piece of dirt here, it takes you 8 years before someone opens the door.
Yep.
And that's tough when you're a developer and you got burned like that. That land costs you real money, and it takes too long. We are top 5 in the OECD for population immigration growth over the next 5 years, but we are number 34 out of 35 in the OECD for speed of permits. Like, we just got to change the metrics. We have to incentivize municipalities and governments to drive the bus, because if you build more supply, people will have more choice, prices will find their happy medium, and sure, developers will, contribute affordable housing in order to get, a big tower built. Like at Oak Ridge, we're building, 300 units of affordable housing. We're handing the keys to the city of Vancouver, and it'll be affordable nonprofits that occupy that building. We have a rental tower in that complex too. It can happen, but you gotta take the red tape out.
And Kevin and I talked about it earlier, and we're also building in Canada and the US, our group. And how is it that you can go down to the US and most markets and buy a property, and 8 months later you're under construction? It's unbelievable how quick it is. And it's because all 3 levels of government are working together to get stuff done. Yeah. So Jon, I know you spent a lot of time on the UDI, Urban Development Institute, and also many hours on committees at City Hall, so you've heard this topic,
Yeah, I think I'm coming up on being the longest chair of UDI. They won't let me go.
They don't let you go,
And amazing, I never would have known going into development, how political it is and how involved it is in the success and failure around public policy, but it's almost impossible to describe how broken our entitlement models are at primarily the municipal government, but also provincial government level. And all the lip service year after year after year, it is the only industry, if it's an industry that I've observed, that somehow manages to deliver worse service year in, year out over my entire career. So it's heading to a real crisis point. I think, I was very involved over the last year or so with Minister Eby, who really surprised us with his willingness to become educated about housing. He's probably the most educated housing minister, no longer housing minister, in the history of the province. Maybe Gordon Campbell knew a lot about real estate too. And so we're really hopeful that there's going to be some legislation coming forward in the fall, maybe more likely the spring now, that's going to be a game changer in terms of changing the power dynamic and the way municipal politics failing to deliver housing approvals. Municipal councils are elected by people who already have their house. Yep. It's the fox guarding the chickens. It's a broken system. And as Remco said, until we fix that, we're going to have, it's already hard enough with interest rates and cap rates and all the things we're talking about, but just that massive uncertainty of approval with the overlay of interventions in the 2%, most recent example, the 2% rent growth, it really makes it hard.
You can't even keep up with your cost to run the building, right?
Yeah, and for investment committees to, take a rental project forward to investment committee now and put all, even though it's a bond, it's a perfect asset, in every other way except because it's so in need, it's meddled with, right? Both in the approval phase and the management phase.
Even a simple thing like insurance, that's not capped at 2%. Your costs as an owner are not capped.
Yeah.
Shenoor, you are active in this sector.
Yeah, and I would sort of just add, because I think we've covered a lot. You look at 3 levels of government. I think the federal government actually is just focused on one thing, which is immigration, which means people coming into this country at a rate of 400,000 or 500,000 a year. Current demand for housing in this country is 13.1 million homes, and we're not meeting it. The cost is $80 billion to do it. There isn't enough building going on. There isn't enough approval going on. You have a federal government that's created a CMHC program that allows for us to go out and build, but we're stuck at the civic level, the provincial level. There just isn't harmony in the government levels to create an environment where a developer can successfully deliver rental that's affordable for people to live in. The sad story is that because it's immigration is the main priority of the federal government, which brings in more people, which creates jobs, which increases wages, which in turn we try to build places that were in sub 2% vacancy across the country, except for maybe the prairies right now. And then we've got housing, you're increasing those rents initially, and then they're flattening out because of these increases that have been put on, the caps that have been put on in the increases. So it's just really difficult to see how we can achieve this. And as developers, we're seen to be bad people, and we're actually part of the solution, and there's no credit given to that. Something that we haven't spoken about is, and I think, Kevin, you did, which was the Indigenous projects that are occurring in this city, in Metro Vancouver overall, that are getting delivered, and they will actually meet the housing demand that we need on the rental side. They will meet the affordable part because they can rent for 30% lower. Their land cost is zero. I think this is phenomenal, but it doesn't allow us to compete in a space and deliver what's needed.
So Kevin, you've got some, not that you needed more evidence and support, but you can see how frustrated the development community is getting speed to market product, the red tape.
Yeah, no, absolutely. I mean, my first job in government actually was under Gordon Campbell, was minister responsible for red tape, to reduce it by a third in our first 3 years. And boy, it's shocking how much there is. We actually exceeded that 42%, but it's all crept back into government again, unfortunately. And the government is one of the shocking statistics I found, because I was out for 10 years working with Eric, but when I went back, I was looking through the budget, and I saw that the employee growth has grown by 30% in 5 years. Oh. That's 120,000 people. And I don't know about you folks, but I haven't seen a 30% improvement in services. So I do wonder what all these people are doing. Yeah. And I can tell you it's not adding value or making things go quicker. It's slowing everything down. There's way too much process, way too many meetings, way too much discussions, not enough outcome focus. It's a huge problem.
Good for Remco, because there's more money going into his pot of money.
Yeah, that's
right?
For
sure. I just want to jump in on that, because I want to defend the government a little bit. Not too much, but as I'm sitting on the left with Kevin over there, in the left wing of the stage, is that you have to ask yourself, why is that, and where's that coming from? Is it because, they just love being incompetent and in the way? And no, they don't. I mean, most politicians, not all of them, most politicians get into the business because they want to make the world a better place. And many civil servants take pride in their work and want to do good work. You have to look at yourself a little bit, and the citizens that vote for politicians and advocate for NIMBY policies and complexity. The world is complicated right now, as we talked about earlier, and we worry. We worry about the environment. We worry about all these, how to reduce our carbon footprints, and that turns into things like the building code gets really complicated. Well, okay, so then somebody's got to enforce the building code. So you got to hire a bunch of people to do that. And then they invent new rules because they're there. And where there's 130,000 new people in BC, that's nice. There's nobody in the city of Vancouver they've hired to help with planning to do the approvals there. But that's a misbalance, right? Mismatch there. So sometimes it's us, because we want lots of things from our government. We don't really think through what they are. And then the politicians, because they want to please you to get your vote, don't have the courage to say, we can't do that. Or if we do that, it's going to really bog things down and you're going to have new problems. So maybe we should help there. I just want to, my dad was a civil servant, he's a nice guy.
And just to add to that, I think, the election cycles are so short, and these problems are a much longer timeline, and they can't be addressed because you can't get the vote. Mm-hmm. It's problematic.
Mm-hmm. Yeah, no, short-term thinking is a big challenge, and I think that we have to have people that have the courage to make long-term decisions, thinking about the next generation, whether it's infrastructure or policy or what have you. And but I agree with Eric, and I said that earlier, that there are some really good public servants, but what they really need is really clear direction and clarity. Because if they don't get it, then they go and shift into neutral. Because there's no wins in being a civil servant and venturing out on your own and trying things. Normally, you get punished or penalized. So that clear direction from the political level is really important. And where it doesn't exist, then you get, paper moving around and not a lot of outcomes.
Okay, let's move on to the next topic, which is office. I want to talk about the office asset class. And Remco, I'm going to start with you. And on the video introduction, we showed a picture of the old post office on Georgia Street and that has been redeveloped into the home for Amazon, right, for their head office. And you've got a great blend of the old with the new. We don't have much heritage in our city, and I know, Jon, you've got done a lot with the heritage, but Remco, that's just a great example of what we should do with our real estate. So we're now 2.5 years since COVID emerged in March 2020, and I think this asset class has been impacted the most with office towers, with many people electing to work from home. But what's really amazing to me is how all the companies, not just here but globally, they honored their lease obligations. It's shocking, and these towers were empty. That didn't happen in industrial or multifamily or other asset class, but in office it was definitely, prevalent there. So what's your view on work from office, I call it, versus work from home, or hybrid model, and how will this impact the demand for office space going forward? Because you have a big position in office. Yep. And then while we're at it, if you want to touch on it, what was interesting to me before COVID was these co-working companies, WeWork, and they just went on an expansion tear, and they probably created a bit of a false environment for what really the demand for office space was. And at one point, WeWork was the largest tenant in Manhattan, pre-COVID. I'm not sure, I don't think they are right now. So do you, as you talk about the office topic here, do you think that business line will go away, or do you think it'll thrive as people come back to work?
Yeah, I mean, we're still not where we hope to be in terms, I would have expected it by this point that occupancy in our buildings, and we track everything, and every door has got a sensor on it to tell us how many people are walking through it. And in Alberta, actually, we're at 50% in our downtown office portfolio. Toronto, Vancouver, 30 to 40%, depending on the building, in the downtown buildings. So that's, comparing physical folks who walk in and out of doors relative to what it was pre-COVID. When I talk to tenants, when I talk to the big occupiers, when I talk to some of the tech companies, a lot of the leaders are saying, we made it through COVID with the innovation and some of the great ideas that we had before COVID, and we made it work. But the collaboration, the innovation, the collisions in the hallway, the ideas that kind of pop into someone's head when they're in a meeting with someone else, that kind of stuff ain't happening the way it used to. And we got to get that back. We got to get our mojo back. So I think a lot of employers, just given the current employment dynamic, are very reluctant to push the button and say, hey guys, we need you back in a big way. But I think that's going to change, and a good recession might just get us there.
I think it's the pendulum's going to swing, and it's about time. And
but hybrid, don't get me wrong, hybrid in some way, shape, or form is here to stay. Is it going to be, people, working remotely forever? Not a chance. Yep. And I think that, I know a lot of our tenants are looking at how they can make their space more conducive to a better working environment. I mean, you think about 20 years of office space, we used to have 250 square feet per person, we went to 200, we said, well, let's sardine them in at 150, then we're doing 110 square feet per person. People don't want to live in a cage. Yeah. Yeah. They don't want to go to work and be in 110 square feet. So you're going to have this need for hybrid, like, I want to work from home, or I want to work remote a day a week, 2 days a week. But then at the same time, I'm going to say, when I come into the office, don't put me in 110. I want a nice meeting room. I want, 200 square feet. So you're going to have these two things offsetting. I think you're going to see flat absorption for a period of time, and then a recovery for office space. And it's interesting, here in Vancouver, through the midst of COVID, Amazon expanded beyond what they have with us at the Post. We did a huge deal with Facebook in Toronto in the midst of COVID. It just went firm in January, and we did a deal out of Broadway Tech that was 200,000 square feet with tech. So these tenants are making decisions, notwithstanding COVID, because they know they need that.
That's a remarkable thing about the office sector, how it's still thriving, even though not everybody's back to the office. So,
We've got about 1 million square feet of just over of AAA office in our pipeline, like that's just either about to go under construction or still being entitled. We just filled up a building, 135,000 square feet, Burrard Place, with 2 tenants. Lululemon took 120,000 square feet. Harrison Healthcare rounded it out with another floor, and I totally agree with Remco about the work from home. And to your comment about WeWork, I don't think WeWork was ever the biggest tenant. I think they're a proxy for enterprise technology tenants, whether it's Salesforce or Microsoft or whatever. So, I think the bigger risk to office right now is not work from home, but it's just our sector was being driven primarily by tech. You look at Microsoft just did a big deal, in downtown Vancouver. Those guys are on the skids with their equities right now. Your charts showed, and they've all got their horns pulled in. So for us, with our pipeline of office, our biggest consideration is when are those guys going to get back to expanding? And I also agree with Remco about the quality of these office buildings. The level of amenities and infrastructure that's going into making the workplace environment completely different is unprecedented. So all the next cycle of buildings are going to have a level of amenity that exceeds the last round, and it's just going to keep going up.
Yeah, and it's like touchless entry, and it's just the HVAC,
air quality,
all those things important. Shenoor, you don't have a lot of office product.
I don't have any office.
Is that by design?
It is by design.
Okay.
It's for us. It's a really large scale investment, and the size of our organization, we try to do a lot of deals that are under 100 million, and to stay in that snack bracket. It's really difficult to do an office deal where your TI costs could run you anywhere from $5 to $10 million at any one time, and the timeline is longer, so it's a lot hard for us to pay.
It's definitely the most capital-intensive asset class. Absolutely.
Yeah.
Eric?
Yeah, well, I kind of been from the Elon Musk school on this one, which is if you're not in the office on Monday, you can go pretend to work from home for someone else.
Yeah.
I think that, obviously, the two things happened. We had COVID, so we had to stay home to protect ourselves, and then, technology coincidentally showed up that day, and we got used to video conferencing, and it's quite convenient. You can walk in your pajamas down the hall, make your 9 o'clock board meeting with your tie and your shirt above your shorts or whatever. And it was nice for about a week or two, or maybe even a month. I think that people could get kind of hooked on it. It's a complacency thing. It's like that kid in the basement playing computer games. It's just pleasant playing computer games. It's pleasant walking down the hall going to work, right? And I think that what Remco was talking about, collaboration and the way people interact, that is so essential in a corporate culture. All the people stuff we were talking about. You can't get that working from home. Meeting's over, you hit leave, that's it, it's done. Now you're looking at your blank screen, you walk down to the kitchen, get a cup of coffee, another donut, and so that's the other not good thing. Get a lot of paces in the day. And so I think that businesses ultimately will say, this isn't good for our business, and individuals will say, this is even good for me. So there will be a hybrid model, because it's quite convenient when you're overworked and overloaded to have that day where you don't have to commute and you can get some extra work time in, but not to the extent you get complacent or lose your connection. So on my call is that it'll be like a day a week, not 2 days a week, that for whatever these acronyms are. Maybe a day a week, and some people won't work from home at all, and some might need a bit more than that, but it'll average out to about 80%, which means that if you're using really rudimentary arithmetic, that means we need 80% of the space. But we're growing, we'll catch up. So we'll have 5 years of this discombobulation, and then we'll be in a new place of most people come to work. Some not, but most people, and we'll get on with it. And then Dunsmuir Street will be fully populated with restaurants again. There'll be a bit of a vibe. It's funny, there's no vibe at 10 in the morning, but I tell you, when everyone's coming from the suburbs on Friday, come downtown for a restaurant during COVID, when they're afraid of COVID to go to work, but they're not afraid to go to the restaurant, It tells you
They'll go to hockey games, restaurants, concerts, but you can't go to the office, you get COVID.
No. Let's get the world going together again.
Yeah.
Let's get some mojo.
I think we're lucky.
Mojo? Love that word.
Real estate is very collaborative, and I think that was probably the first sector that was back in the office. And because that's how we operate, certainly in Vancouver. And you need those face-to-face. It's hard to do it on Zoom, so I think we're very fortunate that people wanted to come back to the office. So Kevin, just before we leave this topic, the government staff, are they all working from home? Are they working in the office? Or what are they doing?
No, I think we're in the opposition, so I don't have a huge staff, frankly, as opposition. But my understanding is most of the government civil servants are still working from home.
Really?
Yeah, we're all back to work, like in the legislature, and our staff, our small team that we have have been back at work for quite a while, actually.
Okay, let's move on to the next topic here, which is industrial. And Shenoor, I'm going to start with you on industrial, because you like industrial a lot. Yeah. It's lower capital intensive, right? Amazon recently announced that they're shedding 53 million square feet from their warehouse footprint in North America. And I think the headline's a bit misleading because they're not really returning 53 million square feet to the marketplace. They're just pausing on projects that amount up to 53 million. So there might be a couple that they might put back for sublease, but really a lot of that product is they're just going to pause or stall the new construction and commitments. So that company on its own has had a material impact on the industrial market in North America. And it's no doubt had an impact on the retail sector too, in terms of, the e-commerce flourishing. So if Amazon is pulling back on their expansion, maybe it's just a case of overshooting the runway a little bit, for their distribution space going forward, how will this impact the industrial markets overall? And don't you think one of the reasons that maybe they're pausing, because they expanded so quickly, is perhaps that they don't have enough workers to actually put in those sorting facilities?
Well, it's interesting. I mean, first of all, we have a very small percentage of Amazon warehouses in Canada. The majority of them are in the US because the e-commerce market there is much larger than it is in Canada. What we have seen, and Remco can add more to this because you actually have them as a tenant, that downsizing is not downsizing, it's forward thinking. I think that they will continue growing, but I think they're adjusting for what we're seeing in the market where retail is actually active again. There are fewer people going to go buy in retail, but the sales numbers are the same with fewer people. So there's this shift going on where people are starting to go to bricks and mortars to buy, and there's maybe a slight slowdown on the e-commerce side. But I don't think that that's for long. I think that both those sectors move forward in the right direction with growth. And so the part that you talk about in terms of human resources and not having access to workers is definitely a problem, but I think it's the robotics, because most of those warehouses are incredibly automated. You build them, they put $250 million into each one of these warehouses, and they haven't been able to get the materials to build them out, so I think that's stretched them a little bit. So I think it's a pause. I don't think it's actually a shrink.
Yeah.
And I think overall, if you want to talk industrial, the industrial market, had obsolescence in it throughout the country, and in the last 5 years, we're seeing a tremendous amount of new product coming on, and the variety of rents go from $12 to $20 a square foot across this country, from sort of the B, C stuff to the A stuff, and there's demand. And you can look at a small place like Victoria, which hasn't seen any new product at all, and it's obsolete. And I think Eric's doing stuff, we're doing stuff with you, where we've seen huge demand, and it's irrelevant. The interest rates are irrelevant. They want new space. They're looking at the future, and they want to be in logistics, manufacturing, small business, whatever the case may be. There is demand.
And industrial, for those in the audience that don't know, has been really probably one of the hottest sectors out there. The vacancy rate in Vancouver and Toronto is probably below 1%. Yep. And rents, which were forever at 5 net, now we're at 15 to 20 net. It's insane, the growth that's happening there. So that's why we bought a lot of industrial. That's why a lot of you have done a lot of industrial. So it's a great asset class. So John, do you have much industrial in your portfolio?
Okay, really light on industrial, although we do have a 7-acre site in downtown Victoria that's industrial zone,
right,
and we're working on a mixed-use project there that should have some inner-city industrial. But yeah, we're pretty light on industrial. We, like everything you have in industrial, we have in office.
Yeah. Remco.
Yeah, so we have a big portfolio in Canada, a big portfolio in the US, expanding portfolio in London. We love the space. we would be, well, our biggest tenant in the U.S. and in Canada and in the industrial space is Amazon. To Shenoor's point, you invest $500 million in one of those 5-story warehouses, they put 250 in. They certainly there's a lot of people in those boxes, but there's a lot of robots, and there's a lot of mechanization, and automation is unbelievable in e-commerce. And if you just look at Canada, e-commerce penetration is 6 to 7%. I think the bulk of that 53 million square foot number is in the U.S. Yep. And I don't have any doubt that Amazon will be one of the winners long term when the smoke clears. I mean, when you're growing as fast as they've been growing, it's easy to your point, overshoot the runway. Yeah. You build a few extra boxes, but you'll absorb them.
Yeah, I think they're just catching the breath because they just grew so fast. Yeah. Eric, I know you're big on industrial, big supporter of that.
Yeah, it's like if you go back to human behavior, we evolve as culturally, we evolve as people. So this whole consuming products directly in your house from wherever they're coming from via Amazon or whoever is a huge factor in that. And so I think it's like a rock star asset class and will be for a long time. But I also was thinking the other day about deglobalization. And globalization is all about just-in-time delivery. Like you order shrimp from, I don't know, Vietnam on Monday, and it's in your dinner bowl on Tuesday. And it doesn't really stop in many places along the way. And I think that we're going to have to store a bit more stuff for a bit longer, because that's sort of, as you get, your supply chains get disrupted like they are right now, that you're going to have to store stuff. It's going to become a little less efficient. I think that's going to add to what was already this growing demand for logistics space, so I think it's good. And this whole thing about Amazon, you already touched it. It's just we're adjusting, figuring it out as you go, as you make this huge surge into this new aspect of humanity.
So I want to move on to the next, because I want to get a few more questions in here. I want to be sensitive to time here, so I want to move on to retail. And Remco, I'm going to start with you because you did touch on Oak Ridge, and I think the audience would love to learn. You're building a mini city there at Oak Ridge, and I think that as we have emerged from COVID here, you've probably seen it where the malls were dead, and now they're coming back to life, right? So it's kind of rebounding.
It's been really, really, really encouraging. Just COVID was a tough period for a lot of folks, and originally our plan with Oak Ridge was we'll shut down, it was the 3rd best performing mall in Canada, we'll shut down half of it and we'll keep the tenants working in half, and then we will build one half of Oak Ridge, and then when we're done that, we'll go back and we'll do the other half. COVID came along, and to the tenants we said, and if you stick around, you can stay, and you could stay at Oak Ridge, and they're performing well. When COVID came, nobody was happy. And we said, okay, we'll let you all out, but we're going to build it faster. And that's been kind of a blessing in disguise. I would say, it's always been a luxury mall. I think what you'll see when it comes back is luxury. The absolute high end is still really, really strong globally, and Oak Ridge will be every bit of that. And will attract the best in the world. It's a mini city with a 9-acre park and close to 3,000 homes. So it's an ambitious project, but thus far the reception, if you haven't seen the marketing center that's just down in Shaw Tower, it's pretty spectacular, and we're pleased.
And Kevin and I were talking about earlier having density at the SkyTrain stops. You've got the Canada line that goes from downtown up to the airport. That's pretty critical to building that kind of density in that location.
It's one of our theses. You can't, like getting transit, as Kevin knows, getting a SkyTrain line takes forever. Yeah. So you don't buy a piece of land and say, well, one day I'll get a SkyTrain line. You go to the land that's got the SkyTrain line, whether it's here, or we have Willowbrook Shopping Center. Maybe one day it'll have a transit line. Capilano Mall. These are densification opportunities with not a lot of neighbors that'll have a problem with it, and great places to put towers and mixed use.
Jon, you have a lot of retail embedded in your office projects too, so what's your experience been?
Yeah, I mean, we've never really been a big fan of or dedicated retail, really, it's almost a function of the fact that in the downtown where most of our assets are, you have to have retail at grade, and it does offer an opportunity for specialty, specialty real estate. I think Broadway, where we have quite a few projects as well, is going to offer a bit more opportunity for larger footprints of retail, grocery, and so on. So it's a bit of it's kind of a sidecar component of our high density office and residential development. Yeah.
I'm not personally big on retail because I think the tenants are whiners, and it's I'm not. It's really difficult. They have a different set of criteria, and I think if you're going to go big in retail, you just can't do it part way. You got to go all in, and you have relationships in multiple cities, with tenants, and multiple projects. So I think you're either all in or you're not. Shenoor, on retail?
Currently, we don't have any, but...
you don't have office or retail, right?
I just do industrial and multifamily.
There you go, that's good.
But we have owned retail in the past, and we've actually focused on grocery-anchored or pharmacy, just service-type centers, and they've done really well. We've had them in Edmonton, Brampton, Toronto, outside of Toronto, and it's worked out well. We've repositioned them. And it's just been really a value add repositioning plan where we're in, we renew, and we're out. Again, not there for a long time and committed to a community or going around a transportation corridor or anything like that. That's more of our residential portfolio.
And Eric, my knowledge of your retail portfolio, it's not less of the enclosed malls, it's more of the neighborhood type shopping center variety.
Right. Well, that's just it. There's retail and there's retail and there's retail. There's all different categories. The high end, the fashion, hard goods versus soft goods, food, booze, drugs for services, etc. I think that retail is going to be around forever. I don't think it's going to completely go away because I'm Amazon. Amazon's great and get stuff sent to you, but you don't get to shop and touch it and taste it and feel it and that sort of thing. And I think that we're tactile creatures. We like to have an experience and go and figure out what it is we're going to buy, depending on what the products are. So our experience is that retail, that's food stores and anything where you want to have an experience is actually weathered the storm quite well post the first year of COVID or whatever. And at this point in time, I'm looking at our portfolio as quite stable, which I think it reflects what I just said. But not all retail is going to be safe in the future. Again, it's like that adjusting we were talking about in the industrial. We figure out the best way to have logistics work, to work with like the whole new distribution models and the Amazon model. What is the new retail model that takes into account that new aspect of human behavior? How does human behavior adjust over on the retail side? So we're liking experiences, and we're liking food and beverage, and we're liking drugstores, liquor stores, banks. I used to say Starbucks, but they closed them all down. So I guess Tim Hortons.
Yeah. Okay, so I'm going to move on to one last question, and then we're going to do a couple rapid fire Q&A, and then we're going to open up to the audience if they want to ask a few questions at the end, and then we can let everybody go. So last question before the rapid fire Q&A. If you had to build a portfolio, I'm going to start with you, Shenoor. I think I know your answer already. If you had to build a portfolio, what it would be composed of in terms of asset class and the cities, the geography?
So our focus is that we are doing build to own. We started to do it last year in anticipation of sort of a economic downturn and interest rates going up. So we're focused on building rental with a community focus where whatever we build has a daycare or some sort of amenity that adds to the community that we're in. And then, of course, industrial. And I would say to you, Vancouver for multifamily, and industrial in Alberta, and outside of the GTA.
Alberta's getting some love. I like that.
I've always been there. I like it a lot.
John, what would your portfolio look like?
Yeah, I sort of work from like a real estate hierarchy of need. Everybody needs a place to live. That's why residential was so strong in COVID, because it was also where you worked. So rental and condominium development, kind of indifferent depending on just the metrics of the particular deal and what the incentives are, followed by office. Followed by retail, and then industrial. Industrial's in there in the hierarchy. It's just never really an asset class that we've made any penetration to, so we figure if we buy it, we're making a mistake. Somebody else should have been there already. Yeah. But really interested in following that hierarchy of need, and definitely, the dire shortages in all types of home ownership. That's our favorite place to be, followed by office.
And geography?
So we're urban, and we like Vancouver and we like Victoria, inner city. But we have made our first large suburban acquisition on Vancouver Island, about a 2,800 home waterfront community just outside of Victoria, which is a little bit of a hedge that we sort of got onto during COVID when we saw that big swing, you know, and that big take up in suburban property. But I still think urban wins in the long run.
Remco, you're so big, you gotta own everything. So.
I'll be boring then. I'll be boring. Residential, industrial. Vancouver, not for rent, for residential, but certainly industrial, and GTA, certainly industrial and residential. We back up the truck for that. We have two other asset classes that we like a lot: student housing in the U.S., where you can really get the rents, and we really like manufactured homes. Or effectively MHC land lease. I think most people call them trailer parks. We're the biggest owner of trailer parks in Canada, and we're looking at some things in the U.S., and that's a really attractive space. No capex, great asset class.
Eric?
I want to do absolutely everything, always, everywhere. When you're highly focused on a diversified strategy, you make a lot of money. I know, but I'm sort of half serious. I like the real estate asset classes that synergize and work well together, like urban mixed-use projects where you have residential, a little bit of office, not too much, retail, service-oriented retail, food, booze, drugs, that sort of thing, in a street grid that ties into rapid transit. Those are awesome asset classes. Love industrial for the reasons we already talked about. As you go to the suburbs, the new version of a suburban community where it's got lots of trails and it's walkable, it's highly livable. It's not just the grids that I grew up in. It's like a really nice environment. It's got retail that sort of works well in different forms of housing. Not just every house is the same, but big ones, medium ones, little ones, short ones, duplexes, row houses, townhouses, that type of thing. What we don't want to do is the weird stuff like hotels, because it's an operating business. Nursing homes, again, it's an operating business. Self-storage, don't understand it. We're highly focused on about 6 other asset classes, but we'll leave those ones alone. Anywhere in Western North America in a city that's growing, so that's Vancouver, Calgary, Edmonton. As you go in the United States, it's Denver, it's Dallas, it's Austin, and Northern California, inland, avoiding Seattle, San Francisco, and Los Angeles. They're too complicated. And because we're Canadian, and because it is the center of the universe, we'll have to go to Toronto at some point.
Just for the record, I love self-storage, and we have a lot of it. And you're right, you need a management team. It's an operating business, and if you have the right team, you can definitely run it.
Mark, I was just going to say on self-storage, because it's been talked about a bit tonight, both Vancouver and Victoria have moved in recent months, weeks even, to make self-storage illegal in industrial areas.
Yes, we've heard that.
So they didn't get the shipyard they were hoping for, and they got mini storage instead, so they're making it illegal
tougher.
now.
Yeah. Okay, so we're going to do some rapid fire 2 questions here, and Kevin, you can participate in this, and then we'll open up to the audience for if they have any questions. So, and Shenoor, I'll start with you. We'll go down the line here. What do you see as the biggest threats to your business going forward in the short to medium term, and where do you see the biggest opportunities?
I think the projects that we already have in play, that's where the fear lies, because there is so much uncertainty as it relates to rates, interest rates, and the lending environment, and approvals. So I think, on a short-term basis, we're pregnant with stuff. We got to really, really focus on it and make sure we get through. And on, I think, the long-term basis, is that part? I think we feel really comfortable on the build-to-own side and building multifamily in Vancouver for the future, because it's really zero risk if you can get through the next couple of years.
Yeah. John?
Yeah, I mean, we're all in the same sandbox on interest rates and construction costs and approvals and stuff, so in a way you could almost discount that because we'll all go through it together. And Shenoor already mentioned it. I think the biggest potential disruptor to our market in both solving problems and creating problems is this juggernaut of First Nations development, which we're only just beginning to grasp. What a different set of rules those developers are going to be living by. Mm-hmm. And I think we're going to need to be really watching that. And obviously the hedge on that is to try to get involved, mm-hmm. which a lot of developers are doing now.
They're joining in, yeah. Remco?
Yeah, and it's the biggest threat to our business in the next little while, and it has been for the last couple of years, is policy. Do we have the policies that support our business and make it easy for us to be part of the solution? And that's really, really important now. And I'm glad that we have some leadership that is thinking that way and maybe has a bit of a development headspace, because we need it desperately. And so on the opportunity front, in a market like this, I like debt. We do, we're equity investors, we're also debt investors. We have a big mortgage book. And, with where rates are now, and certainly for the next 18 months while pricing sorts itself out, we certainly like the space of being a lender.
Looks pretty attractive. Eric?
Yeah, the public policy is obviously a huge threat. It's a pain, and I think it's been the bane on our sides for the last 6 years. But what really freaks me out would be Xi Jinping and Vladimir Putin, because the amount of global instability that's been caused by these massive COVID lockdowns and what it's done to the supply chain, and then the Ukraine war and what it's done to the supply chain and confidence. But that's really what's brought on this huge inflation, which now central banks are trying to cure with this quantitative tightening, which then has had all these tail whip things I was talking about earlier. And I think that whatever they do next, we think we're worried about interest rates and the cost of concrete, and what the alderman or city councilor is going to do on taking too long for an approval. If Vladimir Putin was to launch a tactical nuclear missile in Kiev, it'd be a whole new day tomorrow, right? That's the kind of black swan event that I'm most concerned about. In terms of the opportunity, in theory, when things get tight and there's going to be recession, there's opportunity, there's bankruptcy, and there's death and destruction, and it's an opportunity to go in and pick up all the pieces. I don't think that's going to happen. I think we're going to have this stuckness I was talking about before, and so nothing will really move. So that won't be the opportunity. I think the opportunity will be to do your job really well. If you work hard and you are careful and thoughtful and you grind out an extra 0.5% on your margin, which is the difference between success and miserable failure, I think that's the opportunity. And so that's what we're going to do. We're going to work hard. We're farmers. In the 80s, I thought we were acquisitors and hunters, killing prey. Now we just grow wheat. We grow it in good years and bad. Sometimes it's bumper crop.
Kevin, what do you see as the
putting
threat?
aside all the macro risks, economic, political, all those black swan potential events, putting that aside, the biggest threat is, I think, government getting in the way of itself and not realizing it, and getting in the way of all the opportunity that's there. The biggest opportunity, ironically, is government. I think if government gets it right and can create the right incentive, I always say that developers are pretty simple. Actually, all businesses. Just give them a sandbox they know what to play in. They just have to know the rules. What capital and investment hates is when they jump into the sandbox and then everything starts changing. That is deadly. So I think if we can get the policy opportunities right, then I think we can fix a lot of these problems.
Thank you. Okay, so we are going to open up for the audience to ask questions, and I think we're going to have a couple of, might have to turn the lights up a bit here, but if there's nobody that's shy and wants to ask a question, we have a couple of Nicola Wealth representatives with mics, and you can put up your hand if you want to ask a question. I think we got one here. Yeah. You might have to stand up while we get you a mic. Yeah, there we go. If you can stand up, yeah, thank you.
Hi, Eric. My question is for you. How have you navigated the increased costs from your sub-trades on your active construction sites, particularly given the supply chain issues in recent times?
Well, the first thing you try to do is sell your product for more money to pay for those higher costs. The second thing you do is you work with your trades really hard. There's some of it's unavoidable. Wages go up, you're going to pay that cost. Material costs go up, you're going to pay those costs. So it's about being ahead of it and making sure you've planned for it appropriately. But I think that the number one thing is to have good, open, strong communication and relationship with your trades. So always take the cheaper bid if you can, but don't do it at the expense of not having a great relationship, because it's developing the understanding that's going to allow you to get good bids in the first place. If a trade doesn't like you, or if they're scared of what you're going to do to them, they're going to put a premium amount on their profit margin on their bid. And I think that the more you are in a good place with them, the less that will happen. It's constant communication. It's a lot of work. It's that farming thing I was talking about a minute ago. But that only goes so far. Like if costs double, then your costs double, then it can be very difficult. But as I said earlier, I think we're going to work all this out over time.
Thank you.
Do we have any other questions? Oh, we got one in the back there. Okay.
Hi, good evening. My name is Francis Lee. I just want to extend from my family to the Nicola community and family for anybody who's going through a hard time with illnesses and their health. Because it's one of the hardest things that anybody has to, or family goes through. We are here among the well-off, if I can say that. And sometimes the human aspect of things gets lost. And I'm saying that because my family is in healthcare. I'm a physician, my wife a wonderful nurse, and my daughter is a physician also. I grew up in Hong Kong, and there was a time when my mom and dad, my aunt, and 9 siblings between the age of 1 and 15 were homeless. And now I look at us here, and the only reason I got here because my sisters sacrificed their dreams so that I kept mine. They sailed through storms so that I kept safe haven. And I will never, never forget that. And I'm new to the Nicola community and family because of one lovely young lady by the name of Laura, who we trust totally. Okay? And human trust and compassion is the most important thing. I am going to be with the Nicola family for a while, and so is my family. But what I would love to see is the Nicola family and with the panel. The panel here I see in front of me is the leaders of everything. They have knowledge, they have wealth, they can contribute. And I'm so happy to hear how well we are doing with Nicola Health and all the individual companies. But what I would love to see is some concrete contributions of these magnificent people in front of me to social justice and home care, as well as housing, because that's what we are facing now. I was homeless once, so I know what it means to be homeless, and I know what it means to face the impossibility of even renting something. And I hope that the people here will take that to heart, and even if we take a percentage of what we would make in the future and contribute to our social justice and social community, I and my family, for one, would totally support that. Thank you.
Thank you for sharing that story. I think we have time for maybe 1 or 2 more quick questions, and then we want to let everybody get on with their evening and our panel. So is there any more questions before? Got a shy group. I guess everybody wants to get out for a drink. Okay, so I'll maybe take this moment to ask the audience to join me in thanking this wonderful group of people that donated their time today to come and share their expertise with us tonight. So please join me in thanking them. All right. Great, thank you.
Thank you. Thanks.